The U.S. economy looks invincible on the surface, but that is exactly what makes it vulnerable. Confidence masks structural cracks that could trigger a systemic breakdown at any moment. Most people fail to notice these warning signs because everything appears normal. Stock markets are hitting record highs while national debt continues to explode. On paper, growth seems unstoppable, but history tells a different story. Every major collapse started under similar everything is fine conditions. The danger today is not an overnight crash, but a slow-motion collapse. It is the invisible erosion of stability, occurring quietly while the public is distracted. 4 major crises are converging simultaneously in the U.S. economy. Each crisis alone is dangerous, but together they form a feedback loop that could destabilize the system. These are not speculative risks or distant predictions. These are real, present-day pressures, already affecting markets, debt, and global confidence. To understand what's happening, we need to analyze patterns, not headlines. History has a rhythm, and economies often fail in predictable cycles. The pattern begins with expansion fueled by debt. Borrowing drives growth, boosts asset prices, and creates optimism across the economy. At first, this debt-driven growth seems perfectly sustainable. The economy appears to be healthy, even booming, but over time the system becomes dependent on ever-increasing debt. Growth slows, yet obligations continue to rise at alarming rates. Eventually, borrowing produces diminishing returns. The system becomes fragile, unable to absorb shocks without intervention. This fragility is hidden beneath the surface. Everything still appears normal to most observers, but stress is quietly building. Every additional layer of debt increases systemic risk. The first crisis is the explosive scale of U.S. government debt. By 2023, federal debt surpassed $33 trillion. Debt now exceeds 120% of GDP, a threshold historically linked with slower growth. Governments with similar debt burdens in the past faced severe constraints. The real problem lies in debt servicing costs. Rising interest rates make even basic obligations harder to manage. Higher rates trigger more borrowing to cover existing debt. This creates a compounding cycle that feeds on itself. Over time, the system reaches a point where normal growth cannot keep up. This is the tipping point every major historical crisis exhibits. The second crisis is the fragility of the banking system. Modern banks rely heavily on public confidence rather than full reserves. Only a fraction of deposits are kept in cash. The rest is invested or loaned, creating vulnerability under stress. If confidence falters, withdrawals can spike suddenly. Liquidity disappears almost instantly, threatening the system. The 2008 crisis is a clear example. Banks collapsed not due to lack of assets, but due to the rapid devaluation of risky holdings. Central banks intervened with massive liquidity injections to stabilize the system. Short-term calm returned, but long-term risk increased. This solution encouraged even more debt accumulation. The system became more dependent on cheap money, magnifying future vulnerabilities. The third crisis is inflation and monetary instability. Inflation erodes the value of money and reduces purchasing power for everyone. During 2020-2021, trillions of dollars were injected to support the economy. While necessary at the time, these actions increased the money supply dramatically. By 2022, inflation soared to roughly 9%, the highest in over 40 years. Policymakers were forced to respond aggressively. Interest rates were raised at the fastest pace in decades. This tightened credit and created pressure across financial markets. Higher rates slow borrowing and investment, exposing weaknesses in both households and corporations. Inflation control becomes a delicate balancing act. The fourth crisis is global confidence in the U.S. dollar. For decades, the dollar has served as the world's reserve currency, enabling low borrowing costs and international dominance. No currency lasts forever, and history shows transitions can take decades. The British pound once dominated global trade before being replaced by the dollar. Today, some nations are exploring alternatives to the dollar. While this shift is gradual, it has far-reaching implications for global finance. Reduced dollar demand increases borrowing costs and reduces U.S. leverage in global markets. Even minor shifts can amplify systemic risk. The convergence of all 4 crises creates unprecedented pressure. Debt, banking fragility, inflation, and currency risks are interacting in real time. Rising debt increases interest expenses, which stresses banks and slows growth. Slower growth, in turn, makes debt harder to service. Inflation complicates monetary policy, leaving fewer options to stabilize the system. Every decision carries trade-offs that can worsen another crisis. The result is a feedback loop. Solutions to one problem often exacerbate another. Looking back at history helps us understand today's risks. The Great Depression began under superficially healthy conditions. In 1929, excessive leverage and speculation created fragility. When asset prices fell, banks failed and credit dried up, leading to a prolonged economic contraction. Another example is the 1970s stagflation. High inflation coincided with slow growth, demonstrating how monetary mismanagement can produce economic stress. Japan's 1990s lost decade followed a similar pattern. A massive asset bubble collapsed, debt remained high, and growth stagnated for decades. These examples illustrate a repeating pattern: debt buildup, policy missteps, asset bubbles, and eventual instability. Understanding these patterns is crucial for recognizing current threats. In the present U.S. system, these same pressures are evident. Debt is historically high, banks are leveraged, inflation persists, and global confidence faces emerging cracks. Interest rates have increased sharply after years of near-zero policy. This exposes hidden vulnerabilities across the financial system. Financial markets are volatile, reacting strongly to small changes in expectations. Housing, corporate debt, and consumer spending all face stress. Housing affordability is declining rapidly as mortgage rates rise. Historically, housing downturns often presage broader economic instability. Corporate debt is at record levels. Companies face increasing refinancing costs, reducing profitability and investment. Global economic conditions amplify the risk. China's slowing growth and European challenges impact U.S. exports and global trade. Emerging markets are particularly sensitive to U.S. policy changes. Capital outflows from rising U.S. rates create financial strain abroad. Currency fluctuations add further pressure. A stronger dollar makes exports less competitive, while increasing stress on foreign debt denominated in dollars. Government deficits continue to rise. Spending still exceeds revenue, increasing reliance on borrowing. This growing debt load creates policy dilemmas. Every action carries trade-offs that may intensify another crisis. Central banks are now operating with fewer options. Interest rate adjustments and liquidity injections have diminished effectiveness. Confidence in the system plays a decisive role. If confidence erodes, even small shocks can trigger outsized effects. Market volatility signals rising uncertainty. Investors and institutions are increasingly cautious, reflecting underlying risk. Despite warning signs, the system continues to function. This false sense of security masks deep structural weakness. Historically, this is when risk is highest. The economy appears stable, but pressure continues to build beneath the surface. Eventually, corrections occur, sometimes gradual, sometimes sudden, but always impactful. Outcomes depend on policy, global conditions, and public confidence. No single factor alone determines the future. Economic collapses rarely happen overnight. They unfold in phases over months or years. Each phase builds on previous conditions. Expansion, imbalance, stress, and correction are the predictable stages. Today, the U.S. economy appears to be entering the stress phase. Multiple indicators confirm rising risk across debt, banking, inflation, and global confidence. This does not guarantee collapse, but it indicates that instability is increasing and conditions are fragile. Understanding these patterns provides an advantage. Those who see structural risk early can prepare, while most react too late. The narrative of collapse is often misunderstood. It is a slow process of systemic transformation, not sudden panic. Structural weaknesses are often invisible. They only appear under pressure when stress exposes fragility. History repeats because human behavior does not change. Borrowing, speculation, and policy missteps recur under similar conditions. The current environment mirrors past crises. Debt accumulation, leverage, and inflation pressures align with historical warning signs. Interest rate increases reveal vulnerabilities across households, businesses, and government. Higher borrowing costs affect every sector simultaneously. Consumer spending is slowing. Higher costs for essentials reduce discretionary income and demand. Corporate earnings are under pressure. Rising debt service reduces profits and limits investment and growth. Financial institutions are exposed to rising defaults. Non-performing loans threaten liquidity and confidence. Global interconnectedness magnifies these risks. Economic stress abroad quickly spreads to the U.S. financial system. Emerging markets with dollar-denominated debt face capital flight. This can trigger cascading effects on global trade and investment. Currency markets reflect rising uncertainty. Sudden moves can amplify domestic and global financial risk. Government borrowing continues to rise despite slowing growth. This adds to debt service pressure and reduces policy flexibility. Fiscal constraints limit the government's ability to intervene during crises. Each additional dollar of debt compounds the challenge. Central banks face a tightening dilemma. Raising rates reduces inflation, but risks recession. Easing stimulates growth, but risks higher inflation. Confidence in the system is the hidden linchpin. Once lost, restoring trust is extremely difficult. Market volatility indicates rising uncertainty. Small shocks can trigger outsized reactions due to structural fragility. Despite these signals, public perception remains calm. Most people continue normal financial behavior, unaware of systemic pressure. This apparent calm is misleading. The system is quietly under stress, like a pressure cooker reaching its limit. Corrections can take multiple forms. Stock market drops, housing downturns, or banking crises are all possible outcomes. History shows recovery is possible, but only after adjustment. Those adjustments can be painful and prolonged. Transformation often follows collapse. Old systems weaken while new mechanisms emerge to replace them. The key lesson is understanding the cycle. Debt accumulation, banking stress, inflation, and confidence erosion are predictable patterns. Ignoring these signals is dangerous. Most people and institutions fail to react until it is too late. Awareness allows preparation. Investors, policymakers, and citizens can make informed choices based on systemic trends. The real story is not fear, but foresight. Recognizing structural weakness provides strategic advantage. Current U.S. conditions echo multiple historical crises. The parallels are too striking to ignore. Debt, banking fragility, inflation, and currency shifts interact in complex ways. Their convergence increases systemic risk. Small policy missteps can have outsized consequences. This is why understanding the pattern is critical. Market signals are already flashing. Volatility, slowing growth, and rising interest costs highlight underlying instability. Confidence remains the hidden variable. Once shaken, the system becomes vulnerable to cascading failures. The economy is not collapsing suddenly. It is slowly moving towards structural transformation. Historical patterns provide context. Every major economic reset followed similar phases of debt, stress, and correction. The present moment is a critical juncture. Decisions made today will shape the financial system for years to come. Individuals, corporations, and governments all face trade-offs. Understanding risk is essential for strategic choices. The paradox of stability is that it can hide the greatest risk. Everything may seem fine, but pressure is mounting beneath the surface. Those who understand the cycle early are positioned to respond effectively. Knowledge and awareness are the first defenses against systemic risk. The U.S. economy is undergoing a historic transformation. Recognizing the patterns today allows us to navigate the uncertainty of tomorrow.